Hi guys, welcome back to Tax Q&A. In today's video, I'll be answering the most asked questions about unlisted share. Let's get started. Unlisted shares. These are shares of companies that are not listed on stock exchanges. You know, startups, small private companies, or even larger ones that haven't gone public yet. Lately, unlisted shares have been getting a lot of attention because of the booming startup ecosystem in India. The most recent case was of Swiggy, where people were rushing to buy their shares before its IPO. Currently as well, companies like Boat, NSE and Oyo are trending in the private markets. But why unlisted shares? It all boils down to one thing: returns. Everyone wants to make money and invest in growth companies. One way is to get the shares when such companies go for the IPO. But IPOs have become incredibly competitive in recent years. This is because some companies have offered such good listing gains and the stock prices have even doubled post IPOs. So people try to get a piece of the company even before the IPO by buying unlisted shares. This gives you an early bird advantage and hence a chance to get potentially high returns. Well, unlike listed shares, which you can buy simply through your stockbroker, getting unlisted shares is a bit tricky. Since the company isn't listed on the stock exchange, only a few people, like promoters, employees, or private investors, hold these shares. To buy them, you usually have to connect with these shareholders directly. For example, an employee might want to sell their ESOPs to cash out, and you can negotiate with them to purchase those shares. Then there are brokers or dealers who specialize in unlisted shares. These guys are like middlemen. You tell them, hey, I want shares of so-and-so company, and they'll connect you with someone who's selling. Another option, if you don't want to buy shares directly, there are portfolio management services and AIFs, which is alternate investment funds. These funds include unlisted shares in their portfolios. So you get exposure to the growth potential without having to negotiate deals yourself. Well, let's put it this way. Unlisted shares can be rewarding, but they come with their own set of risks. And in fact, these are riskier than listed shares. Unlisted shares belong to companies that don't trade on stock exchanges, which means companies aren't obligated to make all disclosures of their business and financials. Another factor is liquidity. You might not always find a buyer that easily, and hence your money could be tied up for a while. And in case you had bought the shares to sell them after IPO, who knows, the company actually never goes public. Lastly, unlisted stocks are primarily traded in the grey market, an informal setup outside SEBI's direct oversight. So, higher risk of fraud. If the company goes for an IPO and gets listed, your unlisted shares are automatically converted into listed shares. You can then trade them on the stock exchanges just like other listed shares. No, you actually can't. While buying unlisted shares does give you early access to a company's shares before the IPO, it comes with a catch. Unlike IPO investors who can sell their shares on listing day and book profits, unlisted shares are subject to a mandatory 6-month lock-in period. This means you can't sell them immediately after the company goes public. So, if you're investing in unlisted shares, you need to have a strong conviction that the stock price will continue to rise even after 6 months, or be prepared to stay invested for the long term. Unlisted shares are taxed differently from listed shares. For starters, the holding period that determines whether the gain is short-term or long-term is 24 months. If you sell them before this period, the profit is considered short-term and taxed as per your slab rate. In case you hold them for more than 24 months, the gains will be long-term and taxed at 12.5%. So, for most assets, you only need to report the capital gains in the ITR. This means that you only report them when you have sold something. But for unlisted shares, it is mandatory to report even if you're just holding them. You need to disclose unlisted shares under the section Schedule Part A General Information of the ITR form, where you'll have to enter a few details like the name and PAN of the company, the number of shares held, cost of acquisition, etc. Well, in that case, you can claim these losses by filing your ITR and use them to set off other capital gains. But remember, short-term losses can be adjusted against both short-term and long-term gains, while long-term losses can only be adjusted against long-term gains. It depends. Unlisted shares certainly have their appeal, allowing you to invest in companies during their growth stage. If these companies become big, their shares can turn into multi-baggers, delivering significant returns. However, the flip side is just as real. The company might underperform and the investment could go south. As we've discussed, unlisted shares come with challenges like limited liquidity, less transparency, and higher risk. If you're prepared to navigate these hurdles and are comfortable with the potential downsides, they can be a valuable addition to your portfolio. However, I would suggest that unlisted shares should only be a fraction of your total portfolio. And with that, it's a wrap. If Google search is too much work for you, Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one. You know, startups, yeah, be adjusted against. मेरी chair बहुत पी हो रही है. तुझे नहीं पती है English. Take it from the top. Comfort. My audience requires comfort from me. I should be talking like I'm their pal.